Welcome to the deep dive. If you've ever dipped your toe into investing, you know it can feel, well, frankly, like staring at a wall of hieroglyphs.
Right.
Yeah.
Thousands of stocks charts that look like spaghetti.
And everyone seems to have the secret sauce, usually behind a paywall. It's just overwhelming. Honestly, it often stops people before they even start. But today, we're hoping to, cut through all that noise. We've got a source here, a beginner's guide, that claims to boil it all down to one thing, the index fund. So our mission for this deep dive is pretty clear. What are these things? How do they actually work? And are they really this reliable, almost hands-off way to build wealth over the long run?
And that point about reliable simplicity, that's really key for you, the listener trying to learn this stuff. I mean, the sheer amount of financial advice out there is almost designed to make you feel confused, right?
Yeah, analysis paralysis.
Exactly. Index funds are kind of the antidote. They basically say, look, forget the complexity. The simple path, the one based on just tracking the market, is often the most proven path. It's about math, not magic.
Okay, let's unpack this then. If we're simplifying investing right down, what's the quick pitch for an index fund?
Well, at its absolute core, an index fund is just an investment designed to copy or mirror the performance of a specific market index. Think of it like a benchmark.
Okay.
And the key thing is it's passive. There isn't some manager actively trying to pick winning stocks and beat the market. It just tracks the index. Simple as that.
Right. And the big one everyone talks about, especially in the U.S., is the S&P 500. Can you make that concrete for us? Give us that example.
Sure. So the S&P 500, it tracks about 500 of the largest companies in the U.S. You know, the household names, Apple, Microsoft, Amazon, Google, those guys.
Okay.
Now, if you buy just one share of an S&P 500 index fund, you're instantly getting a tiny slice of all 500 of those companies.
Wow. Okay. So instant diversification.
Instant diversification in one single buy, which, immediately tackles that huge risk new investors face, picking the wrong stock.
Right. Putting all your eggs in one basket.
Exactly. And most people lose money because they bet too heavily on just one or two companies. Our source actually uses a really neat analogy for this risk management idea.
Yeah.
It says instead of buying just one stock, like one single apple, right, and hoping it doesn't spoil, you buy the whole fruit basket.
Ah. Okay.
So if one apple or one company out of those 500 has a bad year or even fails, while the rest of the basket is still full of good fruit, it keeps your overall investment much more stable.
So you're spreading the risk. You're betting on the whole U.S. economy, basically, not just on Apple doing well.
Precisely. It minimizes the damage any single company's failure can do.
So is the main selling point then that it's fundamentally hard for an index fund to completely tank because it's so spread out?
That's a huge part of it, yeah. I mean, it will go down if the whole market goes down. I can't prevent that.
Yeah.
But it protects you from that specific disaster of your one chosen stock collapsing and taking all your money with it. It's like a built-in safety net for the average person.
Okay, this is where it gets really interesting for me because it's not just beginners using these. You see finance pros recommending them too. Our source highlighted, 4 key reasons why they're so popular.
All right.
What's maybe the most, boring reason, but probably the most critical one?
The most boring is the most powerful. Low cost. It's simple, really, because these funds just mimic an index. They're mostly run by computers, by algorithms.
Right.
You don't need those high-flying, super expensive active managers with their big salaries and research teams trying to outsmart everyone.
Okay, wait. If the fees are that low, like fractions of a percent sometimes, how do the companies offering them even make money? Is there a catch I'm missing?
Yeah.
Or is it genuinely just cheaper?
It is genuinely the cheapest way to get that broad market exposure. The catch, if you can call it that, is just scale. Trillions of dollars flow into these funds globally. So the fund providers make a tiny percentage on a massive amount of money. It adds up for them. But for you, the investor, that super low fee means more of your money is actually working for you, compounding, instead of paying someone else's bonus.
That makes sense. And that low cost connects directly to the second big point, right?
Right.
The proven performance. Because intuitively, you'd think, well, surely these expensive managers, these smart people, should beat a simple computer just copying the market.
You'd think so, wouldn't you? But this raises a critical question.
Wow.
Why don't they, usually?
Yeah.
Well, the data year after year shows the opposite. Most actively managed funds actually fail to beat their index benchmarks over the long term.
Really? Why is that?
Two main things, really. First, those higher fees we just talked about act like a constant drag on their returns. It's a hurdle they have to overcome just to break even with the index. Second, active managers trade more often, buying and selling, which racks up trading costs. Plus, let's be honest, they're human. They can get caught up in market hype, chase hot stocks, or panic sell during downturns, just like anyone else.
So behavioral biases kick in.
Exactly. The index fund. It has no emotions. It just follows the rules of the index. Buys what it's told to buy, sells what it's told to sell. No drama.
Which then leads us to the Buffett seal of approval. I mean, when Warren Buffett, arguably the greatest stock picker ever, tells most people to just stick their money in a low-cost S&P 500 index fund.
Yeah.
That feels like a massive statement.
It really is. It's basically the ultimate endorsement from within the finance world, admitting that for the vast majority of people, trying to beat the market just isn't worth the effort or the cost.
Right.
And that brings us nicely to the fourth point, simplicity. Index funds really enable that set it and forget it approach. You don't need to be glued to financial news. You don't need to analyze company reports. You just commit to investing a certain amount regularly, say every month, regardless of whether the market is up or down. Then you just let it ride. Let compounding do its magic over years, decades even.
But hang on, isn't that incredibly hard to actually do, especially now with social media buzzing about the next GameStop or whatever? How do you fight off that FOMO, the fear of missing out, when the index fund path feels so, well, kind of boring?
Yes. That's the million-dollar question, isn't it? That's the behavioral challenge. Recognizing the logic is step one. Trusting the math, which we're about to get into, is step two. But sticking with it, that's the real test.
Okay, before we hit the numbers, what's the biggest psychological mistake people make when they hear this simple plan? Why do they shy away from it?
I think they overestimate what they might gain in, say, 1 year from a risky bet, and they massively underestimate what consistent, boring investing can do over 10, 20, or 30 years. They forget about compounding, or they just never start. Or crucially, they start, then stop when things get scary.
All right. Okay, so let's hit them with the numbers from the source. Let's create that aha moment. The scenario is you invest $500 every single month into an S&P 500 index fund. And you do this consistently for 30 years.
Okay.
And we're using the historical average annual return for the S&P 500 here, which, factoring in ups and downs, inflation, has generally been somewhere in the ballpark of 8 to 10% per year over long periods.
Right. That's a reasonable long-term expectation based on history. So if you stick to that plan, $500 a month for 30 years, where does that potentially leave you? Well, connecting this to the bigger picture, after those 30 years, your investment could quite realistically grow to somewhere between $600,000 and $700,000, maybe even more, depending on the exact market returns during that period.
$600,000 to $700,000. Okay.
Now, here's the kicker. Here's the part you really need to let sink in. Over those 30 years, how much did you actually invest out of your own pocket?
$500 a month times 12 months times 30 years. That's $180,000.
Exactly. $180,000 contributed by you. But the account grew to $600K, $700K. So where did the rest come from? That's over $400,000, maybe $500,000 or more.
That's purely from growth, from the returns compounding year after year.
Purely from compound growth.
Yeah.
Your earnings started earning their own earnings. That's the engine. That is the magic of long-term investing right there. Does the heavy lifting for you.
Wow. Okay, so this really hammers home that famous investing saying the research always mentions time in the market beats timing the market.
Absolutely. You don't need to be a genius predicting the peaks and troughs. You just need to get in, stay in, and keep adding consistently. Let time do its work.
Yeah.
And maybe we should also mention the flip side, the cost of not investing. If that $500 a month just sits in a standard savings account.
It's losing value to inflation every year.
Precisely. So investing, even in something average, like an index fund, isn't just about getting rich. It's also about protecting your future buying power. That's a risk people often ignore when they think cash is safe. Now, it's worth pointing out, not all index funds are clones of the S&P 500. There are different flavors, tracking different parts of the market. It helps to know the basic landscape.
Okay.
You'll generally come across three main types. First, stock index funds. That includes the S&P 500 we've been talking about, but also things like a total stock market index fund, which might track thousands of U.S. companies, large and small.
Right, even broader.
Even broader. Second, you have bond index funds. These invest in bonds, which are generally lower risk than stocks. They usually offer lower returns too, and people often use them more as they get closer to retirement to stabilize their portfolio.
Makes sense.
And third, international index funds. These track stock markets outside your home country, giving you global diversification.
Okay, so quite a few options. For someone listening now, thinking, okay, I'm ready to actually do this, where's the best starting point? Which fruit basket should they grab first?
Well, the guidance we reviewed is pretty consistent on this. For a beginner, the simplest and often most effective starting point is either an S&P 500 index fund or a broad total U.S. stock market index fund,
So by those.
because they give you massive diversification across the core of the market right away without needing you to make complicated choices about which type of company or which country to bet on. Keep it simple, keep it broad, keep it low cost.
Got it.
And maybe just a quick technical point here. When you go to actually invest, you might see index funds offered as either ETFs, exchange-traded funds, or traditional mutual funds.
Right, like VOO versus FXAIX that the source mentioned. What's a practical difference for someone just starting out?
Well, ETFs, like VOO, trade like stocks throughout the day. You can buy or sell them anytime the market's open. Mutual funds, like FXAIs, typically only price once at the end of the day.
Okay, so why does that matter if I'm just planning to put in, say, $500 every month?
For that specific strategy, dollar cost averaging, putting in a fixed amount regularly, a mutual fund can sometimes be a bit simpler. You put your order in for $500 and you get whatever the closing price is that day. Easy.
Mm-hmm.
ETFs offer more flexibility if you wanted to trade more actively, maybe set specific buy prices. But honestly, for that simple, consistent monthly investing, either works fine. The absolute key is just picking one with a very low expense ratio. That fee matters way more than the specific structure.
Okay, let's make this super actionable. Someone's convinced they're ready. The guide laid out some simple steps to get started right.
Yeah, pretty straightforward.
Okay, step one was choose a brokerage. Basically, you need an account somewhere to actually buy the funds. Places like Vanguard, Fidelity, Charles Schwab were mentioned, or maybe newer apps like Robinhood, or Zerodha if you're listening in India. The main thing is finding one with easy access to low-cost index funds.
Right. Low fees are paramount.
Step 2. Pick your index fund. And as we just said, for beginners, sticking to a broad market one like an S&P 500 or total stock market fund is usually the way to go. Things like VOO or FXAIX are common examples.
Yep, keep it simple.
Step 3. Decide your investment style. The recommendation is usually dollar cost averaging. That means investing a fixed amount regularly, maybe monthly or bi-weekly. This helps average out your purchase price over time, less stress than trying to time the market.
Definitely helps smooth out the ride.
And step 4, maybe the hardest one, consistency and patience. Stick with the plan. Don't panic and sell just because the market has a bad week or month or even year. Trust the long-term process.
And that leads us right into the reality check, the pros and cons, because index funds aren't some magic bullet for instant wealth, are they? There are trade-offs.
Right. So the pros seem clear. Easy, low cost, diversified, great long-term growth potential. What are the downsides?
Well, the main con, if you see it that way, is that your returns will be average. By definition, an index fund aims to match the market's performance, not beat it.
Okay, but hold on. Why should someone settle for average? We just talked about that $700,000 number over 30 years, which sounds fantastic. But what if my neighbor's bragging about doubling their money on some crypto coin or a hot tech stock in 6 months? Isn't average kind of unambitious?
That's a really common feeling. But here's the thing. When we say average in this context, we mean the market average. And historically, the market average has delivered really strong long-term growth, as those numbers show. The attempt to beat that average is where most individual investors get into trouble. Try and pick the next hot stock or time the market perfectly. The data shows most people who try that actually end up underperforming the boring old average index fund. Why? Because they trade too much, incur costs, make emotional mistakes.
Ah, okay. So average is actually reliably good, whereas trying to be above average is often reliably worse.
That's a great way to put it. You're accepting a mathematically sound, historically proven return instead of chasing lottery tickets. The average market return is actually a pretty high bar that most active efforts fail to clear consistently.
Okay, that makes sense. What other cons are there?
The other big one is directly related to that patience point we keep hitting. It requires patience.
Yeah.
This isn't a get-rich-quick scheme. It takes years, decades.
Right.
And even though, intellectually that markets go up and down, seeing your investment value drop during a downturn is still tough. Market slumps will happen, and your index fund will lose value temporarily. You have to be able to stomach that without panicking.
So the cons aren't really about the fund itself, but more about the investor's own psychology.
Largely, yes. The biggest barrier isn't understanding index funds. It's mastering your own emotions during the inevitable rough patches. Can you stick to the plan when the headlines are screaming, see a rash? Can you keep investing when your balance is down 20%? That emotional discipline is critical.
So ultimately, the source seems to conclude that for most everyday people who just want steady growth without becoming finance experts, the benefits, the simplicity, low cost, diversification, proven returns, they really do outweigh those cons, provided you have the discipline.
Exactly. Index funds are arguably one of the most powerful democratic tools ever created for wealth building. They level the playing field. You don't need inside knowledge or a fancy degree. You just need consistency and time. Hashtag tag out. So wrapping this up, what we've seen is that index funds offer a really clear, evidence-based path to building wealth over time. They take the guesswork and, frankly, a lot of the stress out of investing.
Yeah, the key takeaways for you listening seem to be start early if you can, be consistent with your contributions, choose a low-cost, broad market index fund, and then, well, mostly just let time and the power of compounding do the real work for you.
It's about discipline over brilliance.
Right. And that brings us to a final thought to leave you with. We saw that powerful example of $500 a month potentially growing into over $500,000 in 30 years, largely thanks to compounding. We also identified that the biggest hurdle isn't picking the fund, it's the patience required to stick with it through market downturns. So consider this. If the logic is simple, the math is compelling, and the action is just. Keep investing regularly. Why is mastering that emotional side, the ability to ignore the fear, resist the urge to sell during a panic, and just do nothing, or even keep buying? Why is that the hardest, yet maybe the most crucial element in making this whole long-term strategy actually succeed? Think about the mental fortitude needed to see red in your account and stay the course. That might be the real challenge and the real key to unlocking that long-term wealth.